This video is strictly for educational purposes. I do not condone, commend, or recommend any form of tax evasion. That's definitely not what's going on here, and would never make a 10 to 15 minute YouTube video on how to avoid paying taxes in detail. Never. But taxes, nobody loves them, but we all have to deal with them. The wealthy, however, have mastered the art of using legal loopholes to keep more of their money. This video should break down some tax loopholes that can help you reduce your tax burden legally. No shady business, just smart planning. Let's get into it. The foreign earned income exclusion, the legal tax hack for global earners. Imagine this. You're sitting on a beach in Thailand sipping fresh coconut water, your laptop open as you casually finish up a work email. The sun is setting, the waves are crashing, and the best part, the IRS isn't knocking on your door asking for a cut of your paycheck. Sounds too good to be true? Well, it's not if you know about the foreign earned income exclusion. This completely legal tax loophole allows US citizens living and working abroad to exclude up to $120,000 plus from their taxable income. That means if you qualify, you could be earning six figures and paying little to no US income tax. How does it work exactly? The FEIE is designed for Americans who genuinely live and work outside the US. So it's not just a loophole you can use for a quick vacation. You need to prove to the IRS that you're not just gallivanting across Europe for fun, but actually residing in another country. Difficult, I know. There are two ways to qualify. The physical presence test. You must spend at least 330 full days in a foreign country during a 12-month period. It doesn't have to be a calendar year. It can be any continuous 12 months. The bona fide residence test. You need to establish a legitimate residence in another country for an entire tax year. This means getting a long-term visa, a foreign address, and making it clear that you actually live there, renting an apartment, paying foreign taxes, etc. Who can benefit? You probably, if you play your cards right. Also, remote workers and digital nomads. If you're working online from Bali, Mexico City, or Lisbon, you could be eligible. Freelancers and entrepreneurs running a business abroad, this could be a huge tax break. Expat employees. If your company sends you overseas, you might qualify. The catch? There are a few things to keep in mind. It only applies to earned income. Salary, wages, and self-employment income qualify, but passive income, like dividends or rental income, does not. You still have to file taxes. Even if you exclude all your income, you still need to file a US tax return. State taxes may still apply. Some states, like California, make it difficult to cut tax ties unless you officially change residency. I'm sure you're wondering, why doesn't everyone use this? Well, first off, most Americans don't even know it exists. The IRS doesn't exactly advertise, hey, here's how to pay less in taxes. Second, moving abroad is a big step. And while this loophole is incredible, it's only useful if you're truly willing to live outside the US for most of the year. The foreign earned income exclusion is one of the most powerful tax breaks available to Americans willing to embrace a global lifestyle. If you've ever dreamed of working from a cafe in Paris or an apartment in Tokyo while keeping more of your hard-earned money, this might just be the strategy for you. Just don't forget to send the IRS a postcard so they know you're still paying attention. Next, the home office deduction, turning your home into a tax haven. Let's be honest, since the rise of remote work, many of us have turned our homes into multifunctional spaces, office by day, gym by night, and occasionally a 5-star restaurant when we actually decide to cook. But did you know that part of your home could actually save you money on taxes? Enter the home office deduction, one of the most overlooked tax breaks available to freelancers, entrepreneurs, and remote workers. If you use part of your home exclusively for work, you can legally deduct a portion of your rent, utilities, and even internet expenses, significantly lowering your taxable income. How does it work? The IRS isn't just giving out tax breaks for anyone answering emails from their couch. First, the space claimed as a home office must be used exclusively and regularly for business purposes. This means that a dedicated room or section of a room must be used solely for work-related activities. If the space serves multiple purposes, such as a guest room or a personal workspace, it will not qualify under IRS guidelines. Second, the home office must be the principal place of business. This means that it should be the primary location where work is conducted, client meetings are held, or administrative tasks are completed. While business activities may occasionally take place elsewhere, the home office must be the central hub for operations. If these requirements are met, then there are two ways you could claim this tax deduction. Method 1, the simplified option. The IRS allows you to deduct $5 per square foot of your home office up to 300 square feet. This means you can automatically write off up to $1,500 per year without having to calculate specific expenses. It's easy, quick, and works best for small home offices. expenses. Highly recommended, of course. Method 2, the actual expense method. If you want maximum deductions, this is where things get interesting. Here's how it goes. Determine what percentage of your home is used for work, e.g., if your office is 10% of your home's total square footage, you can deduct 10% of applicable expenses. Then deduct a portion of rent or mortgage interest, utilities, property taxes, home insurance, and even maintenance costs. Yes, that means a portion of your electricity or water bill could be tax deductible. So if you're using your home for work, why not let it work for you at tax time? The home office deduction is one of the easiest ways to lower your tax bill. Just make sure you're following the rules. And if you need a sign to finally clear out that junk room and turn it into a real home office, this is it. Next, the business expenses method. Maximizing deductions for everyday costs. One of the most effective ways for self-employed individuals and business owners to reduce their taxable income is by deducting legitimate business expenses. The IRS allows deductions for ordinary and necessary expenses incurred in the course of operating a business. These deductions can significantly lower taxable income and, in turn, reduce the amount of taxes owed. To qualify as a deductible business expense, a cost must meet two key criteria. It must be ordinary. This means the expense is common and accepted in the specific industry or line of work. It must be necessary. While not required to be indispensable, the expense should be helpful and appropriate for running the business. A wide range of expenses can be deducted, including office supplies, advertising costs, business travel, professional services, and even a portion of internet and phone bills if they are used for business purposes. For those who work from home, a portion of household expenses, such as utilities and rent, may also qualify if they meet home office deduction requirements. Business meals can also be deducted, provided they are directly related to business activities. In most cases, 50% of the cost of meals with clients, partners, or employees is deductible, as long as the expense is properly documented. Keeping receipts and noting the purpose of the meal and those in attendance is crucial to ensuring compliance with IRS regulations. Travel expenses related to business, such as airfare, lodging, and transportation, can also be deducted, provided they are necessary for conducting business. However, personal expenses incurred during business travel, such as sightseeing or entertainment, are not eligible for deduction. Proper record keeping is essential to claim business expense deductions effectively. Maintaining receipts, invoices, and financial records helps substantiate deductions in the event of an IRS audit. Using accounting software or consulting a tax professional can help ensure that all eligible expenses are accurately recorded and applied. For business owners and self-employed individuals, taking full advantage of deductible expenses is a strategic way to reduce taxable income while covering the necessary costs of running a business. By understanding which expenses qualify and keeping thorough documentation, taxpayers can ensure they maximize their deductions while staying compliant with tax laws. This might be a basic method, but it has been proven to be very effective. Fourthly, mileage deduction, turning your car into a tax-saving machine. For anyone who uses their personal vehicle for business, the IRS offers a valuable tax break, the mileage deduction. This deduction allows business owners, freelancers, and self-employed individuals to write off a portion of their driving expenses, helping to reduce their taxable income. Now, before anyone gets any ideas, no, your daily commute to work doesn't count. The IRS is pretty firm on that one. However, if you're driving to meet clients, running business-related errands, or traveling to a work site, those miles can be deducted. Essentially, if your car is putting in the work, it deserves a little tax break. There are two ways to calculate the deduction. The standard mileage rate. The IRS sets a fixed rate per mile driven for business purposes. For 2024, this rate is 67 cents per mile. And yes, that extra cent counts when you're racking up hundreds of miles. So if you drive 1,000 miles for business, that's a $670 deduction. Not bad for simply tracking your trips. The actual expense method. This one requires a bit more math, but can lead to a bigger deduction. Instead of using a standard rate, you calculate the actual costs of operating your vehicle. Gas, insurance, repairs, depreciation, then deduct the percentage that applies to business use. If 40% of your driving is for work, 40% of your car-related expenses could be deductible. Both methods are perfectly legal, but once you choose one for the year, you typically have to stick with it. The standard mileage rate is simpler, but if you drive a lot and have high vehicle expenses, the actual expense method might be more beneficial. A key part of claiming the mileage deduction is keeping detailed records. The IRS isn't going to just take your word for it when you say you drove about 1,000 miles. They expect documentation, dates, locations, and the purpose of each trip. Many people use mileage tracking apps, but if you prefer the old-fashioned way, a simple logbook works just as well, as long as you actually remember to fill it out. One common mistake people make is trying to claim personal trips as business mileage. No, driving to pick up your dry cleaning doesn't count just because you made a quick work call in the car. The IRS isn't easily fooled, and nothing says audit like a suspiciously high mileage mileage deduction with no real business to back it up. You might as well fraud written on your forehead. For those who do use their car for business regularly, this deduction can add up quickly. Whether you're a real estate agent, constantly on the road, a freelancer meeting clients across town, or a small business owner running errands, keeping track of your mileage can result in significant tax savings. It's one of the simplest deductions available. Just make sure you're tracking those miles properly, of course. Next, the 1031 exchange, deferring taxes on real estate gains. For real estate investors, one of the most powerful and completely legal ways to avoid paying immediate taxes on profits is through a 1031 exchange. This provision, named after Section 1031 of the US Tax Code, allows investors to defer capital gains taxes when selling a property, so long as they reinvest the proceeds into a similar property. Essentially, it's a tax-free way to level up in the real estate market. Here's how it works. Let's say you bought an investment property for $200,000, and over time, its value has increased to $500,000. If you were to sell it outright, you typically owe capital gains tax on the $300,000 profit. However, under a 1031 exchange, if you take that $500,000 and reinvest it into another like-kind property, you can defer paying taxes on that gain. It's like hitting pause on the IRS's tax bill while you keep growing your real estate portfolio. Of course, there are rules, because the IRS isn't just going to let you dodge taxes without some fine print, like-kind requirement. The new property must be of the same nature as the old one. The good news? The definition of like-kind is broad, meaning you can exchange an apartment building for a shopping centre or raw land for a rental property. However, your personal residence does not qualify. Strict timelines. After selling your property, you have 45 days to identify a replacement property and 180 days to complete the purchase. Miss those deadlines and the IRS comes knocking for its cut. No touching the money. The proceeds from the sale must be held by a qualified intermediary, a third party who facilitates the exchange. If you take the money yourself, even for a second, the IRS will treat it as a taxable sale. The best part, there's no limit to how many times you can use a 1031 exchange. Investors can keep rolling over their gains from one property to another, indefinitely deferring taxes. In some cases, if the investor never sells for cash and instead passes the properties down to heirs, the tax basis resets upon death, meaning the gains may never be taxed at all. It's an incredibly powerful tool for anyone serious about real estate investing. Instead of paying tens or even hundreds of thousands in taxes when selling, investors can use that money to reinvest and expand their portfolios. The key is following the rules carefully, because while the IRS allows this loophole, they also watch it closely. I mean, it's not exactly the most by the book method. This final method might not exactly be for you if you have the time to watch a YouTube video on this, but nonetheless, the private foundations and donor-advised funds, the billionaire tax dodge, are philanthropy, the noble act of giving back, supporting worthy causes, and, if you're wealthy enough, dodging a hefty tax bill in the process. While the rest of us are out here debating whether donating $5 to a GoFundMe counts as charity, the ultra-rich are setting up private foundations and donor-advised funds, DAFs, to shield millions from the IRS. Here's how it works. Instead of paying taxes on a large chunk of income, a wealthy individual can donate that money to their own private foundation or a DAF. Because charitable contributions are tax deductible, this dramatically lowers their taxable income. The best part, they still get to control the money. Let's break down the two main strategies. Private foundations, the personal charity loophole. A private foundation is basically a personal charity that the wealthy create in their own name. Once money is placed in the foundation, it's technically no longer theirs. It belongs to the foundation, but in a shocking twist of events, they and their family members can control how it's spent. The IRS requires that private foundations distribute only 5% of their assets each year, meaning the remaining 95% can sit in investments, growing tax-free indefinitely. So while it looks like generosity, it often functions more like a family trust with better PR. Donor-advised funds, charity on layaway. ARD-DAF is like a charitable savings account. The donor gets a full tax deduction the moment they contribute to it, but they aren't required to distribute those funds immediately, or ever, really. While technically the money has to go to a real charity eventually, there's no strict timeline. Some billionaires use DAFs to delay their giving for years or even generations, while enjoying immediate tax benefits. To put it simply, these loopholes allow the wealthy to look charitable, keep control of their money, and avoid taxes all at the same time, while the rest of us get a polite thank you email. For our $20 donation to disaster relief, the ultra-rich get their names on buildings while their money keeps growing, untaxed. Now, is this illegal? No. Is it morally questionable? That depends on how you feel about billionaires getting massive tax breaks, while public schools hold bake sales to afford new textbooks. But one thing is certain, this strategy is incredibly effective for minimizing taxes while maintaining power over wealth. In conclusion, the key to playing the game, knowing the rules. The IRS isn't handing out tax breaks. You have to find them, document them, and use them strategically. So whether you're an entrepreneur, an investor, or just someone who wants to legally pay less, remember, the tax code isn't just a set of rules, it's a playbook. Learn it and you win.